Hello, everyone, and welcome to our keynote for the second day of EnerCom Dallas. Today, we're really excited to have a panel that's going to share a pretty broad overview of ESG and how it benefits the industry. Just a little bit of housekeeping to start. Suncor's speaker was not able to join us today, unfortunately. Sitting in her place is EnerCom President Aaron Vandeford, who will be able to share sort of the IR side of things. But we're excited to offer capital markets a view into good investable ideas through this conference. And in our conversations with our clients and others, the importance of ESG and sustainable investing continues to come up. And we believe this conference offers a perfect opportunity to explore best practices around ESG and what it means for companies and capital markets. Joining me today to cover ESG and what it means for companies, I'm very pleased to welcome first Jennifer Wazinski, partner with our sponsor Haynes & Boone, who has helped make this panel and our conference possible. Thank you, Jennifer. Neil Stewart, Director of Corporate Outreach at the Sustainability Accounting Standards Board, or SASB, and EnerCom President Aaron Vandeford. Excuse me. I've had the pleasure to speak with each of you three over the last few months and gained a lot of insight into ESG from each of you. Our presenters are going to provide about a 10-minute presentation with their unique perspective, and then we'll go into some Q&A afterwards. Please feel free to submit any of your questions in the Q&A box below the live feed. To kick things off, I'm going to pass it over to Neil Stewart at SASB. Neil, thank you for joining us.
Thanks a lot, Tyler. Thanks very much to EnerCom for involving SASB in this event. Very pleased to get to speak to this group. In the ESG world, and particularly around this interface between companies and their investors, attention really is coalescing around SASB as well as around TCFD, or the Task Force on Climate-Related Financial Disclosures. I think there's a lot of curiosity, a lot of interest in the investor relations world about the benefits that SASB and the SASB standards can bring to corporate reporters and to their shareholders, especially. So if you go on to the next slide, and I'll just give you a sense of what is SASB. We're an independent nonprofit. And after our merger with the IIRC, the International Integrated Reporting Council, which is going to close next month, we'll have dual headquarters in San Francisco and London. So what SASB does is we provide industry-specific ESG disclosure standards, allowing companies and their investors to communicate about the financial impacts of sustainability. Now, what clear standards do is they ensure consistency over time, comparability between companies. They really allow investors and management to better integrate ESG factors and make more informed decisions. And the importance of sustainability in an investor world, I don't think I need to go over that. There's been massive growth since the global financial crisis 12 years ago. And today, really, sustainability risks are seen as business risks. They're operations risks. They're not just reputational. They're global issues. And they really are material to enterprise value. Managing the risks over long term is likely to improve business performance in the form of reduced operating costs and greater resilience to risks, as we've seen in particular over the last year, as well as the potential for competitive advantage. Now, what really differentiates SASB from other standards and frameworks is that we're laser focused on investors, and investors' need for decision useful data on ESG factors. So, and as I said, investors are definitely focusing on the SASB standards these days. Now, going on now and thinking about the landscape, I think it's good to set the scene here and look at, if I could go on to the next slide, and think about the whole landscape. And I know this can look a little bit confusing, somewhat daunting. This is the alphabet soup that we hear about. It can be, to me, it's somewhat frustrating because I hear people talking about, there's 200 frameworks out there, or I saw one reference to 600 frameworks. Look, when it comes down to it, in terms of standards and frameworks for reporting to investors, there's actually a very limited number, a finite number. And if we think about this left-hand group here, that's what these are, standards and frameworks for structuring data to report out. The other groups do different things, and it's important not to confuse the standard setters like SASB with, for example, the ratings firms on the far right-hand side. So MSCI, Sustainalytics, and others, they serve a very different purpose. And then in the middle, you've got questionnaires like DJSI or CDP, and of course, you've got the data aggregators and data distributors. Now, this is very much, it's more confusing than the financial data landscape. And no wonder, this is a much less mature field. And it's never going to become, I think, as straightforward as the financial data landscape. There's too many audiences with different needs, but it does, I think, help to clarify what are the standards frameworks in this landscape. And further to that, if you go on to the next slide, we can think about the difference actually between standards and frameworks. And this is a good example here to think about SASB and TCFD and how they fit together. So in the sense that reporting frameworks like TCFD provide principles-based guidance to help companies identify ESG topics and how to structure and prepare the ESG information they disclose. So it's how to disclose. Reporting standards, in contrast, provide specific and detailed requirements to help companies determine what specific information, both qualitative and quantitative, to disclose around each topic. So framework is how, standards is what, if you will. Now let's talk about the SASB standards. What does SASB reporting look like? SASB, on the next slide, you can see that SASB reporting comes in different shapes and formats. We might see SASB data, SASB standards used as part of a sustainability report or a standalone report. We can see it in some regulatory filings, and increasingly so. And we can see it most often as a data table in the back of a sustainability report or a part of an integrated report. So again, what's most common is companies take the standard, and the standard is that subset of industry-specific topics and their related metrics that matter to the business. And they will put the responses into a SASB table at the back of their sustainability report or as a standalone report on their website. Now, the demand from investors, as I said, is tremendous. And if you go on to the next slide, many people will have heard about BlackRock's request beginning last year, January 2020, and repeated again in this year's letter to CEOs from Larry Fink, the CEO of BlackRock, the world's largest asset manager, was this call for corporate disclosure aligned with SASB and TCFD recommendations. And so this is also reflected in State Street's announcement that they have based their R-factor scoring system on SASB's materiality mapping. And other investors around the world, including NBIM and many others. In fact, this chart at the bottom really shows how widespread it is. A lot of people sometimes identify BlackRock as the investor calling for SASB disclosure, but BlackRock would never have made that request without confidence that this is widespread across the markets. In fact, today, more than 150 asset managers and asset owners representing nearly $70 trillion in assets under management are part of the SASB Alliance, and they include the world's biggest investors. So besides BlackRock and State Street, we've got the biggest active investors like Fidelity and Capital Group. And we have the asset owners, as well as NBIM, we have CalSTRS and CalPERS and so on, the pension funds, the sovereign wealth funds, really around the world. So to put it simply, investors and companies are supporting the SASB standards because they're industry specific, because they link ESG issues to enterprise value creation over the short, medium, and long term. And they're developed using a very rigorous due process involving public comment and market input. For investor relations, and this is a key thing, for investor relations, SASB standards give you the ability to control your story. If your company doesn't disclose this data, a portfolio manager or an index provider or a rating provider is still going to try to reach a conclusion about your ESG performance, but without the use of your data. Now, as a result of this investor push, we're seeing widespread corporate adoption. If you go on to the next slide, This is quite a remarkable chart that appeared just a couple of weeks ago in The Economist, showing the rise in references to SASB and TCFD in the corporate reports, or rather the sustainability reports of S&P 500 companies. So you see the dark red SASB line and the sort of pink TCFD line really on this hockey stick trajectory, rising up in terms of use by US companies. In fact, we've now reached over 770 corporate reporters worldwide. We have just about reached the halfway point of the S&P 500, and we are about a quarter or a third rather now of the S&P Global 1200, so developed markets, large companies. Last month, remarkably, we had 155 SASB reports come out. That compares to about 119 in the whole of 2019, which is the year after the standards were codified. Going on to the next slide, this is, if you are not familiar with the SASB standards, this is maybe a good place to start, because what you can see with our materiality map is exactly how different topics are material to different industries and what their associated metrics are. So this is a good place to go and start looking for your industry and see where you fit into this materiality mapping. From there, it would be the next steps would be to actually download the standard for your industry, which is free to use for corporate reporters. And there are many other resources and materials for your use on SASB's website. That wraps up what I wanted to tell you just to introduce SASB, but I'm looking forward to continuing the discussion, Tyler.
Neil, thank you so much for that overview on SASB. I think it's really helpful for us and for our audience as we learn more about ESG and best practices. Up next, I'm going to introduce Jennifer with Haynes & Boone. Jennifer, thank you so much for joining us today and for Haynes & Boone's continued support of our events.
Thank you, Tyler. We're excited to participate in this conference. So I'm going to talk about the ESG disclosures that we're seeing today in E&P companies in their proxy statements. And so on the next slide, earlier this year, Haynes & Boone partnered with EnerCom to look at the ESG programs and disclosures by a number of U.S. onshore middle market oil and gas producers. And so we are looking at their disclosures both on the websites and in the SEC filings, and we'll track those over time to see how they evolve and develop, because we've already seen quite a bit of development in the last 2 years in these disclosures. So what I'm going to do is go through what we saw in the 2020 proxy statements, but as we talk about the different trends, I'm going to note what we're seeing in 2021, because a number of these companies have filed their proxy statements this year, but not all of them have. So on the next slide, this just gives an overview. If you were to look at the types of disclosures that we're seeing in proxy statements, these are the types, a summary of the different types of disclosures. So not every company will have all of these elements if they talk about ESG in, but we're starting to see more and more of all of these. So we'll go through each one of these in detail, starting on the next slide, which identifies the first trend, which is that we're starting to see ESG highlights talked about in both the CEO letter and the proxy statement summary. And so in 2020, about a third of the companies we looked at included this disclosure. And on the next slide, we'll talk a little bit more about what we're seeing in that disclosure. So for example, if a company really made some significant efforts on ESG in the last year, so let's say they really upped their game on ESG, or they formed an ESG committee or commissioned a sustainability report, or maybe they made some significant progress in terms of reducing emissions, we will see some of that highlighted even in the CEO letter. And then in the proxy statement summary, there often will be some graphics as well as qualitative disclosures talking about where they are on ESG matters. So for example, in the oil and gas companies, you'll see disclosures on reduction in emissions on a year-over-year basis. We see a lot of disclosures on board diversity and tenure statistics as well. One thing that we've noted in looking at the 2021 proxy statement so far is that we're seeing more companies come out and disclose in the proxy statement that their reporting is aligned with TCFD and SASB. And so that kind of echoes what Neil was talking about in terms of the adoption, because companies are starting to actually talk about that in the proxy statement. We're also starting to see more producers disclose a commitment to reducing emissions. On the next slide, this is trend number 2, which is just generally talking about the ESG strategy and the proxy statement. And this tends to be, qualitative, high-level principles disclosure about the commitment to trying to, do good with not only the environment, but social and governance as well. And we saw about half of the companies last year did have qualitative ESG disclosure about their programs in the proxy statement. And on the next slide, some of those disclosures, companies will break out their specific efforts by, the 3 pillars of ESG: environmental, so obviously reduction in emissions, reduction or elimination of flaring is common to talk about, as well as water management. On the social side, we saw a lot of disclosures on the COVID-19 response, because that relates to the social side of ESG, as well as worker safety, commitment and statistics, diversity, both within the board, but also the employee base, which has become a very hot topic of late, as well as community involvement efforts. On the next slide, the third trend, and this is a really important developing trend in the disclosure, and that is for quantitative metrics, because one thing that we know investors have been pushing very hard on is not just to talk about, we want to try to do well by the environment and climate change, et cetera, but they want to see numbers. And one of the challenges that we've had so far, looking at the quantitative metrics that have been disclosed in the proxy statements last year, especially on the environmental side, we tend to see quite a bit of variation. And so it's hard to really compare apples to apples. And I think investors are going to be pushing for those metrics to become more standardized in the disclosure so they can compare company to company. On the next slide, we show a little bit about the different categories of quantitative metrics that we're seeing. So board diversity and director tenure were about the most common quantitative metrics that we saw. And I think one of the reasons for those is those should be relatively easy for the company to put together and track, because obviously before they can disclose these quantitative metrics, they need to make sure those disclosures are vetted and they have the information to back up the disclosure. So I think on the board side, those are fairly easy to do. So we tend to see a lot of those. On the environmental side, you'll see here there were a number of companies that talked about a reduction in emissions or some metric on water management. Those tended to vary a little bit in terms of how they described that. On worker safety, there were a number of companies that talked about the total reportable incidents over a period of time. And then a number of companies would talk about either dollars committed to community causes or social causes, or the number of volunteer hours their employees provided to different causes. And then we saw some companies talking about the reduction in truckloads as being a reduction in indirect emissions by the use of transporting more oil or gas through pipelines rather than through trucks. And so on the next slide, the fourth trend is about stockholder engagement efforts. And I think this is really an interesting one because as of last year, we saw about a third of the companies specifically talk about engaging with stockholders on ESG. And on the next slide, we talk about kind of what's interesting is now companies are not only saying we talked to so many stockholders last year, but many are actually starting to include a chart that goes through here the specific request that the investors wanted, either more quantitative metrics on something they wanted, commitment to reduction on emissions, and then the companies will put in their response. And so this is kind of a sampling of some of those that we've seen in the proxy statement. And I think it's no accident that the bullets on this list correspond directly to the trends that we're seeing in proxy statement disclosure. And that really reflects the fact that almost all of this disclosure that's in the proxy statements today is not required by the SEC. It really is the result of investor demand. And so that goes along with that. And so at the bottom, you see here, we're starting to see investor requests, that there's disclosure that their reporting is aligned with TCFD and SASB. On the next slide, the fifth trend relates to governance. And so as of the proxy statements last year, about a third of the companies disclosed that they had an ESG dedicated committee. Another quarter of the companies described ESG as being subject to the oversight of a standing committee, usually the Nom/Gov committee. We would expect over time that more companies will have ESG governed through an ESG dedicated committee. It's certainly not required, but I think because ESG is such an important topic today that everyone is talking about, and there really is a lot to ESG and managing the oversight and the implementation of an ESG strategy, that I think it can make sense to have a dedicated committee. On the next slide, we'll just talk a little bit more about the ESG governance disclosures, because we're starting to see even more disclosure in the 2021 proxy statements on ESG governance. So I think, a lot of the disclosure last year talked about, well, here, we have an ESG committee and here's the mandate of that committee. They're tasked with doing X, Y, and Z. In the 2021 proxy statements that we've looked at, the disclosure has gone even farther to talk about how ESG oversight is managed at the senior management level. And so it will talk about that and how they report up to the committee and the board. Companies are disclosing how often the board reviews ESG risk, ESG strategy, kind of progress on the strategy. So I think this reflects the fact that investors are really wanting to know how ESG oversight is managed at a more, detailed level. One thing we're also seeing in terms of the governance is that more companies are disclosing in 2021 that they have amended the charter of their ESG committee to specifically talk about racial and ethnic diversity. And, not just at the board level, but within the workforce generally. And that is in direct response to a lot of the, investor demands following the social unrest last year. On the next slide, the next trend is another really important one, and that is that more companies are incorporating ESG metrics into their performance targets. And so we saw a majority of the companies last year had some disclosure in CD&A that indicated that ESG played a part in determining the performance bonus, usually the annual incentive bonus for the executives. And this reflects the fact that investors are really looking to make sure that executives are incentivized to implement the ESG strategy. And on the next slide, it talks a little bit in more detail about what those disclosures look like. So there's variety right now in how companies are doing this. So some companies will say that, they look at their normal TSR and operating metrics to determine the annual incentive bonus. But at the end, they may take some qualitative consideration to ESG progress in determining where the bonus is. So they may adjust it up or down a bit based on that. Other companies are using a scorecard approach and actually incorporating quantitative ESG metrics into that determination of the bonus. And so they may say that, for example, 15% of the bonus is weighted towards ESG metrics, and that's split among several metrics, some of which that we've seen are the worker safety metrics, reduction in emissions, or reduction in spill rate. I would expect as we go through this year and next year that there will be more development on these disclosures, because I think investors are really wanting to see, more disclosure of exactly how ESG plays into the performance compensation. On the next slide, we identify the last trend, which is that we're seeing more companies include a director skills matrix, and that matrix will often identify one or more ESG related characteristics. And so about a third of the companies did that last year. And I think, this one is important to investors because they're wanting to see, not only that the company has an ESG committee, for example, or manages the ESG oversight, but they want to know that the people who are in charge of that have the requisite expertise to do that. And so they want to see that talked about in the proxy statement. And so I think to the next slide, to conclude, I would just say that, ESG is front and center, as I think everyone's kind of been talking about throughout this conference. And so if you're a company that hasn't really started to include these disclosures in your proxy statement or, develop an ESG strategy, it's definitely a great time to dive into it. I would say that it can seem daunting at first, but, this is something that really is a journey for every company, and it's evolving very rapidly, very quickly. So it's something to just make sure you get in and start on and stay up to date with the developments. So thank you.
Jennifer, thank you very much for that. Really appreciate having your perspective. Up next, we have EnerCom President Aaron Vandeford. Aaron, thanks for joining us for the panel.
Hey, thanks, Tyler. And I'll just go ahead and share my slides. And I'm excited to be able to be back with you here today, and excited to be continuing this dialogue of ESG. As I think about, what my role on this panel is and where we see EnerCom. EnerCom, first and foremost, is a consultancy to the energy space in the investor relations and ESG world. And so I'll take off my hosting of conference hat and put on my consulting hat as we talk a little bit about here, and try and provide some of the perspectives that we're seeing with our clients in the investor relations world, and also as we sit and advise some boards while going through this. As Jennifer puts it very well, it's a journey, and where do we start? So first, we've heard throughout this conference, and we hear a lot even in the prior two presentations, the investor world is driving a lot of this ESG and the disclosure in and around it. We view ESG today in the investor relations world as a cost of capital, and really today more as an access to capital issue. There's a strong correlation in the 30 companies that we looked at with Haynes and Boone on the study for companies that were in what would be considered the higher quartile of one, not only disclosing, but better in their metrics. They had true market interactions, whether it be a debt refinancing, even emergence from bankruptcy, thinking of that as a transaction with the market. Folks that were still maybe sitting on the sidelines, maybe haven't started their journey yet, or needed to address the capital markets as much. And so that access to capital, and I think over time we will see potentially a transition to a cost of capital where there may be a true economic benefit to the ESG that's seen in the cost of capital. But I'll share in the next slide here in a little bit. Businesses have already been thinking about ESG, and it makes good business sense. And so now we're thinking a little bit on disclosure. It's no surprise that the E is front and center, but in our conversations and even in letters from the Finks of the world and others, the S and the G are we tend to think about it from an investor relations standpoint equally as important. And as Jennifer had pointed out, the governance may have a little bit more established metrics and guidelines for companies to think about. And I shared in slides yesterday where oil and gas companies actually are better ranked in the governance side of things than many other industries out there. And so we should take pride in that. But that's a good place to start with things that you're already doing. The other things that we hear certainly is this frustration and of the quality of data from companies and maybe the apples to apples comparison of it. And I think that's really where I think we as a firm look at those SASB standards as a great place to start, and also measure where do we as a firm that we're working with kind of stack up? Where are there opportunities? What are we already doing? And it becomes a really nice place to kind of start on that journey. But thinking about ESG and the impact of the corporation, strong ESG translates into good business. And so good top line growth, you're generating better revenues, you've got government relations, you've got the right to operate, cost reductions, you're taking waste out of the system, productivity uplifts, you're taking care of the people that are doing the work for you. Those are all ESG metrics that all of these companies are already doing and focused on. And now it's starting to think about how do we put those out into the marketplace and start that process. But the universe is expanding, and so are the asks on ESG. And so I think the world is changing very, very quickly in what is being asked from different landowners and stakeholders. And so I think what's important for us as an industry in the extractive resources, but even beyond, is to control that dialogue and to have a seat at the table on what is it that we want to make sure that we're conveying to the market on our principles and values in and around these things of ESG. And I think the other component to this is not just to have a podium, but it's that seat at the table where we listen as well. And so as we learned from the proxy statements where companies are putting in, we heard this from investors, here is our response. That is a give and take and a dialogue that has to happen inside of management teams, inside of the boardroom, and all the way through to the folks actually in the field. So we do see that the capital side is a major driver of this. Certainly it's a capital intensive business. And as we looked at those 30 companies in the study we did on the ESG Tractor, the standard names are up front and there was an aggregation. So despite Larry Fink's letter, BlackRock owns 28 of the 30 peers that we looked at. And this was a group of small to mid cap companies greater than $1 million or $100 million market cap and an independently US onshore asset base. And so when you start taking a look at that, we have to listen to what we're hearing, but they're also putting money to these principles. And so I think the other thing that we hear a lot from the capital side of the business is certainly the evolution, companies taking steps forward to address their disclosure. The expectation is not that every company has a fully built out, fully disclosed SASB table. We're going to get there, and I think we'll keep working down that path. So I want to answer just a few questions on what we're seeing and what we're hearing, just to summarize, and then we'll kick off the Q&A and question part. But really here, does ESG disclosure even matter for an independent company? And I would say the short answer is yes. It's an access to capital issue. The question that we've gotten often, and one that's still outstanding, is, well, is my stock price going to be better because I've disclosed this? And right now, the correlation's not necessarily there, but we do see a strong anecdotal evidence that there is more access to capital for folks that are disclosing, and that trend is moving very, very quickly. So we'll keep watching that. The expectations, as I mentioned, are not the same for all size companies. Everyone's going to be a little bit different in this journey, but I think the important thing from a capital markets perspective and the investor relations seat is that there's a perceived movement and then action and building of trust over time in these disclosure methods. ESG metrics take a holistic approach, the E, the S, and the G, but really the first part of that is take a look at what you're doing inside your own organization. Be proud of the work that you guys have already put in, and have a dialogue in and around it. Now, the key is, well, what information do I feel comfortable putting out, what I not. And that's an important dialogue to be thinking about as you put a number out, and messaging. You don't really get to change that once you put it out in the public domain and public space. And so you want to make sure that you're putting out what is core and fundamental and genuine to the business, and continue to move that forward, and use tools like the SASB to help you find and get comfort in what those things are that we should be disclosing and talking about. And so with that, it's been, I've continued to harp on it, but I'll say it one last time, and I'll probably say it again. Start the journey, understand that it's a journey, and that it takes a holistic approach, not just the E, the S, and the G, but it is a board level discussion. It is a management level discussion. It is all the way down into the field. And what we found in our consulting practice is that generally when people are starting this trend, they kind of look around the table and they say, well, where do we start? And it's the investor relations person, because I think the capital side of it kind of raises their hand and said, I'll kind of pick this up, but they're having to get information from all over the company, whether it be from legal, from accounting, from operations, ES&H, much like they are in the rest of the investor relations world. It's a good seat to be able to gather that information, but it's no small task, and it continues to move. And so with that, I'll turn it back to you, Tyler.
Thanks, Aaron. Really appreciate you sharing that with the audience. One thing you mentioned there towards the end was the conversations that we have with a lot of our clients are about what to disclose and when, because once that's out there, you have to continue reporting it. So for the first question, I'm going to direct this towards Jennifer. If a client is thinking about disclosing a particular ESG metric, what advice do you give them on potential liability risks and how to mitigate those risks?
Sure. Well, to start, putting these types of disclosures into SEC filings, they will be subject to a higher liability standard. The CFO and CEO will be signing certifications on those, et cetera. So the first thing I would say is you need to make sure that you're vetting those types of disclosures in a way similar to how you do for financial disclosures. And so you want to make sure that you have the right information to back up that information. So you're needing to, for example, you're wanting to report on reducing emissions, that you have a tracking system set up and that you have a baseline so that then, your reporting will be consistent and accurate from year to year. And thinking about things like, to the extent that it is a forward-looking disclosure, including the appropriate disclaimers there is very important. And thinking too about, while you think about things in SEC filings having a higher liability standard, that doesn't mean that you can just put whatever you want on your website or in the investor presentation, because investors could make a claim based on 10b-5 if they find that those disclosures were materially misleading and they relied on them. And I would expect as the SEC moves forward, they will be looking not only at these disclosures and SEC filings, but they will be looking at the other company disclosures as well and commenting on those.
Thank you for that insight. As we're thinking about the SEC and what's coming next, Neil, can you give us some insight into what SASB is seeing maybe coming down the road as far as reporting goes?
A lot. This is an incredibly dynamic area, and it's moving so much more quickly than any of us could ever have imagined, especially maybe at this point last year. We came into last year with incredible momentum, especially around climate risk. It was going to be a huge year of action leading up to COP26. Then COVID came along. We felt like, oh, this has derailed everything. Instead, it's only accelerated it. And around the area of regulation, you're seeing stock exchanges, you're seeing regulators, you're seeing the entire accounting profession, you're seeing the accounting standard setters, and get into action. And the SEC is definitely among them. Late to the party, but still really coming in the party now. The Biden administration is racing to catch up with the rest of the world. They've created an ESG task force, an ESG czar. They've got a consultation out there on climate reporting. It's going to close in June. If companies should be heard in that, get involved, speak up, make yourselves heard. And what we expect to see is, frankly, we expect to see ESG reporting become mandatory. It's becoming mandatory in many parts of the world, particularly starting with climate. So the UK has announced that TCFD reporting will be mandatory for large companies by 2022 and all companies by 2025. We're seeing similar types of rules passed in Hong Kong, in New Zealand, in Japan, in Taiwan. Often the guidance might be like, for example, in the UK, the Financial Reporting Council has said climate reporting is going to be mandatory, but get started now with TCFD, and for industry-specific factors with SASB. Okay, so you can see how this is developing. I think that the things to watch out for on the global stage, the IFRS Foundation, which oversees the International Financial Reporting Standards. So that's like the international version of US GAAP. They're working on creating a new global sustainability standards board. Now, US companies might say, well, it doesn't affect us. We're US GAAP. That's different. That's outside. Not so. The SEC has sent a clear signal that they will work with the international accounting standard setters. And it may be that this global sustainability standards board ends up setting the baseline ESG standards that companies worldwide will report to. Okay, now there may be additional layers on top of that. For example, in the EU, we see EU taxonomy advancing sustainable development goals, but there is a very good likelihood that even US companies may end up being mandated to report to a global baseline set of ESG standards focused on enterprise value creation, focused on the needs of investors. So this is not going to, we're not going to get into that difficult debate about, well, value versus values, and is this about, like imposing morality or something. No, this is about shareholders. It's about capital. It's about directing the flow of capital. This is not about imposing values on anyone.
Fantastic. And I know that can be a little bit of a thorny issue. And I can't lie, I'm going to take a little bit of pleasure in throwing it at my boss. But Aaron, as we think about applying all of these different shareholder related issues and how they do relate to wider stakeholder issues, how do companies ensure that their messaging is resonating with everybody that's concerned about these ESG metrics and the issues?
Yeah, I think that, the first step is to listen, and it's to listen to what else is the stakeholders are asking for. It's to be observant in what's going on in Europe, to be observant to what your peers are doing, and to have a good understanding on where you actually sit today and where you're going. And so the first step is to take that. Then how do you make a message that resonates? It has to be true to you. It has to be something that you as a firm, as a management team on through are committed to. And so and we see it in a lot of different investor relations spaces where a company may say something and they never act on it, then it takes away and degrades trust. ESG is an element, and today, certainly in today's world, ESG and ESG disclosure must be built upon increasing levels of trust and validation. And that's where I think data, standards, and opportunities to showcase what you're doing build that level of trust. It also allows you to set goals and to move and execute towards those goals. Much like you would say, we're trying to reduce our well costs, we're increasing returns. We now must think of ESG disclosure in those same manners. And as we think about certainly the financial stakeholders carrying a large checkbook for and access to the things that we want to do, the other access and stakeholder we need to be listening to, and Great Western did a great job sharing what's going on in Colorado, is this right to operate. And as we continue to think about those stakeholders in alignment with what we're providing in our financials and being held accountable to, that should also allow us to speak to those type of stakeholders with confidence and with intent. And so I think that it takes an intentional dialogue, and like I said, it starts with listening, and then it takes time to build that trust.
I was hoping to trip you up, but that was a good response. Thank you, Aaron. One thing I would like to add to that too, the conversations that we're having with our clients, building trust is something that should start before a crisis. Whether we're talking about it from an ESG perspective or whether it's media or anything else, you want to start to build that trust ahead of time so that if you need to rely on some of that social capital, it's already there for you. And I think that that's an important part of this equation that maybe isn't discussed enough. For our next question, I kind of want to focus on a particular type of stakeholder, and Jennifer, I'll direct this one to you. If a client is concerned about ESG activism, what advice would you give them on how to handle that?
Well, I would say, and this kind of follows along with what you're just saying, Tyler, that, we think of it that the best defense is a good offense. And that usually here is having already developed a good ESG strategy and already have been articulating that to your stockholders. So, one thing to keep in mind is if you have an activist come on the scene and you immediately think, well, we've got to call up, our big shareholders and talk to them. If you haven't already had a continuing dialogue with those stockholders and that, kind of continuous conversation going, you can bet the activist has had several conversations with those stockholders already. And so that's one reason it's important really to start the dialogue, continue the dialogue, and make sure that before the activist comes on the scene, you already know, one, what your stockholders are looking for, and two, that you're making some progress. Because if you can articulate, what your strategy is when an activist comes in, you're going to be in a much stronger position, and you're also going to be helping to control the narrative on your story versus allowing an activist to come out and just start saying all the things you're doing wrong and kind of put you on the defensive.
Thank you, Jennifer. Neil, I'll direct this next question at you. As companies are figuring out how to report in this world of ESG metrics and all the options that are available to them, how does SASB work with companies in the industry, and how would you guys recommend that companies get involved in that process?
So SASB is based, our standards are based on market input. They're really market informed. During the creation of the standards, we worked with literally thousands of individuals, from companies, from investors, other subject matter experts, law firms, accounting firms, and so on, to create the standards. And now that they are codified, we have to maintain them. So there's a lot of work. We have a team right now, it's 12 analysts and growing. They're CFAs, CPAs, former buy side, sell side, and their job is to research the industries they cover and to undertake standard setting projects and work. And throughout that process, they are engaging with, again, the market, with companies and with investors. So on our website, we have the projects that we're currently working on, and how to get involved, what stage they're at, how to get involved. Are we taking market feedback? Are we have we got something out for public comment, and so on. So I'd encourage companies to take a look at that. Other ways that companies get involved with SASB is I mentioned earlier our SASB Alliance. This is now nearly 220 members. It's about 70% investors today, but an increasing number of companies are joining. And what it is, it's a group it's an education and networking group. The fees that members pay go to support SASB's work as a nonprofit in standard setting. And I want to make it clear, this is not a quid pro quo. This is not a pay as you go. Reporting using SASB standards is entirely free. We don't do any advisory or consulting work. We leave that to the experts like EnerCom. But the Alliance is a way to support SASB's work as well as to network and educate and learn about the standards.
Thank you, Neil. Appreciate the plug. I'm sure we'll pull that out and put it on the conference in August. This next question I'm going to direct towards Aaron. Yesterday we heard Suzanne Ogle with Southern Gas Association talking about the ongoing conversation that needs to take place inside of a company around ESG. And we've heard from, both from within our own consulting practice and from other presenters that this is something that has to happen from the top down. How do you think about implementing a strategy that allows that conversation to happen effectively?
Yeah, so I think, and Susan's point is well taken, and Jennifer's comments and the ESG tracker, we talked about, or we saw data on boards and committees being established in and around ESG. And I think from a lot of our conversations as we listen, we hear that being a good start. So we noticed companies coming out of bankruptcy, we don't need to list them, but they established right out of the gate ESG committees to start and reestablish that trust in the marketplace. And so I think it does start at a board level. It is not a throwaway committee. People are being asked to show credentials on what they're doing and being a part of that committee. But it's something that now we can see and build trust that there's oversight from the board level through to management and on through to implementation. And that implementation is what shows up in the metrics that gets disclosed in the reporting. So that becomes the validation and the trust that the board and management are implementing the things that they say they're doing and doing it well. I think the other trend that we're seeing as a part of that accountability metric is the change in addressing compensation and how management teams are incentivized. And so we know that by incentivizing folks with, monetarily with the things that we would like to see as outcomes, we generally move closer to those goals. And so, even bringing back to what we heard from Billy Bailey on our panel yesterday with Saltstone as a buy-side investor, and compensation is front and center in their minds. And so ESG being tied to some of those things is a step forward. But I think what's going to be really important and where it is today and where it goes tomorrow, I think is going to be a little bit different in that today we're going to have these standards, but it's the metrics of improvement to actually show and benchmark over time the improvement and actual what specific metrics are important. I think those are a continued evolution, but we've seen the first step at that, starting from the board and committees and things like that.
Awesome, thank you. So this next question is going to be a two-parter, and I'm going to let each of you kind of answer it. I'll start with Jennifer, and then we'll go Neil and Aaron. First, I'd like to know what you think the next big change in ESG is going to be. And then I think maybe more importantly, what's the risk to a company for not starting the process now or being late to the game or later to the game if they haven't started already?
Well, so I'll start from my perspective as a corporate and securities attorney. I do expect more to be coming out from the SEC on ESG. As Neil was talking about, they have announced that they're working towards some type of disclosure framework, and they've also announced that they intend to be scrutinizing climate change disclosures in particular. So I think as we go through this year, we'll definitely see more focus on that from the SEC. In terms of risk of not addressing ESG, I mean, there's several things that kind of come to mind. I think, as Aaron talked about, there's certainly the ability to raise capital can be impacted by this. We've seen some stockholder litigation in this area, a breach of fiduciary claims somehow tied to ESG, whether there's a lack of commitment towards diversity or climate change issues. So I think litigation is going to be a risk that may increase over time. The activism, we talked about that a little bit. There's definitely the risk of activism if you're not being, actively involved in ESG today. And then, another thing to think about too is ISS and Glass Lewis have the ability, and they're incorporating ESG metrics into the concept that they could recommend a negative vote or a vote against your directors in the regular annual election of directors if they perceive the company to have poor ESG practices. And I think that is, potentially a really big threat if they start using that, ability to make those recommendations.
Great. Thank you, Jennifer. Neil, same question to you.
So yeah, what's coming? What's next for ESG? I mean, what's next might be that we stop talking about ESG because this is business now. These are business risks. This is how you achieve performance. This is how you create a long-term business model, and we're gonna stop putting this into this bucket of ESG or sustainability, and these are going to be, just be core business issues. Now, what are the consequences? Well, there's license to operate, as Aaron mentioned earlier. There's access to capital, there's cost of capital. But let's remember that this is not just about disclosure. This is not just about transparency. This is about companies making a difference here. I mean, this is about, we've got the risk of climate change, the effects of climate change, physical risk, and then the transition risk to companies. We've got social issues and inequality to address. We've got poverty, and then we've got goals around sustainable development we need to address. So this is about business as a lever for change. It's not just about opening a window on your activities for investors. It's about competing to improve on these ESG factors. So, this is where SASB was founded. SASB was founded not just as a mechanism for disclosure. It was really about, it was actually founded on research out of Harvard called From Transparency to Performance. This idea that if you could manage what you measure, and if you could compete on what you can compare, then you can improve performance on the ESG factors and ultimately on financial performance. And it would be a race to the top. So instead, this is not about competing to who has the nicest sustainability report. This is about competing to see among your peers, how can you drive down emissions? How can you increase the energy efficiency of products? How can you attract and retain talent through good D&I policies, and so on and so on. So I think that's what's coming next, and those are the consequences.
Thank you. And I think that's a really good perspective to share with everyone who's viewing this presentation today. It is about differentiating and setting yourself apart and building a better business through these practices. Aaron, what are your thoughts on this?
Yeah, no, I appreciate, and I'll probably echo a couple things that Neil and Jennifer said, and it is not a new thing that we're going through ESG. It's something that businesses have been doing. It's something that we need to probably talk a little bit more about, but it's all about building a business that can generate returns and sustainable returns for shareholders. And as an extractive resources group that will continue to remain relevant in our energy mix today, it is important that we talk about the sustainability of being an investable idea. And so coming with that becomes the disclosure, comes the talking about our businesses. And I think the biggest change that we'll see in the next year is probably, and we're already seeing it, is the move from, websites and sustainability reports being the major hub for disclosure into documents that may have a little bit more teeth in it, in an effort also to I think companies will want to drive there to say, look, you can trust what we're doing. We're going to do what we say we were going to do. And I think that the risks, and make no mistake about it, Jennifer mentioned some of the activists. Almost every company has had a conversation in and around ESG, and if we're listening, the buy side's not being quiet about what they're wanting. They may not have a specific agenda with a specific company like an activist we would think, but we are an industry that is surrounded by activism in and around ESG. And so we need to be aware of that, but we also need to make sure that we move those things forward with intent. And so those are, I think, some of the risks to see and some of the changes, but I think it's front and center on certainly everyone's mind at this conference, but I think as an industry, it's front and center for oil and gas. But broader than that, this is a discussion that's happening across all companies here in the US and abroad. So that's my summary of what all these other guys said better than I did.
Well, thank you all very much for joining us on the panel today. Jennifer and Neil and Aaron, thank you. Really appreciate your insight on ESG. I think it's been a really valuable conversation for our audience, and one that I expect we will continue to have at least through the rest of this year and at our August conference. So hopefully we'll be able to get you involved there as well. Just want to say thank you once again to Haynes and Boone for helping us make this possible.
Thank you. Great to participate today.
Thanks, Tyler. Thanks, everybody. Good to talk to you.
Thank you.